According to supply managers in the 9 Mid-America states, how is the economy performing?
The economy is underperforming. That's the survey. This is a Creighton survey of manufacturing supply managers for the month of March. The overall index was again below growth neutral, 49.6 from February's 49.1. And this is the third time in the past 4 months it's been below growth neutral. So when it's all said and done, that would be when the federal government revises their numbers later on this year. I think we're going to be able to say that the manufacturing economy in the region was in a recession for all of 2023. Now, not a deep recession, just a dipping into negative territory for the year of 2023 and now beginning 2024. About 68% of the survey participants for the month of March expect a 2024 recession. Either they are reporting they're already in a recession in their area, or they're going to enter a recession in 2024. So not very optimistic looking forward, and not very good right now. But there were some positive factors coming out of the March survey, and I'll talk about that shortly. Now I'll bring up the survey and the graph of the Creighton number compared to the national number, the national PMI, Purchasing Management Index. You see there in beautiful Creighton blue, the overall reading, as I said, was 49.6, and you see it's up slightly. And if you look below that in red is the national PMI, Purchasing Management Index. The overall reading from the national PMI, Purchasing Management Index for the national PMI will likely be below growth neutral. It comes out later on this morning. Both our indices come out on the first business day of each month. Ours normally comes out before theirs. That's the national PMI, the Institute for Supply Management.
What were the hiring trends?
Hiring was not good for the month of March. The overall index, the index for hiring index was 40.9, and that's down significantly. I'll call it significantly from February's weak 42.9. I get concerned when these indices get below 42. So this is a sort of a warning signal, and we'll see how hiring, when it's reported by the federal government, comes out later on next Friday. Next Friday we'll get the employment numbers for the state and for the regions and for the states within the region. Approximately 27.3% of supply managers reported job losses for the month, and job openings were down for all 9 states in the over the past 12 months. So the job market's definitely weakening, but still remains overall remains okay. Now the manufacturing numbers not good. And that's what we're reporting on here.
What inflation trends are you noticing?
Inflation numbers are moving the wrong way. The price gauge, this is of course the wholesale price index, climbed to 77.3. Now all these indices move from 0 to 150 being growth neutral, moved to 77.3, and that's up fairly significantly from February's 61.9. So that's some real concern. I think the market by investors is getting way ahead of the Federal Reserve. The Federal Reserve is going to be concerned about these numbers, which are showing more inflationary pressures than we'd like to see. The inflation rate remains above the Fed's target, that's for sure, and we're going to see it for the first half of 2024. And of course, what's added to the concern here is the Baltimore port disaster. That's going to mean supply chain disruptions. There will be more supply chain disruptions moving forward than we've seen in the past. We've got what's going on in terms of rebuilding in Baltimore, but we've got the Red Sea supply chain disruptions in the Red Sea, the battle there going on with Hamas and Israel spilling over into the supply chain. Of course, we've got the Ukraine-Russia war, which is a real concern, obviously from a lot of reasons, but also because of supply chain disruptions. And 1 in 4 supply managers, in fact, reported an increase in March supply chain disruptions. So we're already seeing those. And most of the survey was conducted before the disaster in Baltimore. So I expect the numbers, again, to worsen in terms of supply chain disruptions in the weeks and months ahead.
What is the economic outlook?
The outlook is still not strong for manufacturing. And again, the overall economy, at least according to the federal government statistics, is holding up. But I say there's a lot of revisions going on from the federal government. So one month they'll be reporting, like last month was 275,000 new jobs. No, the revisions that normally will be revised down. Our numbers will probably be revised down as well. I expect no change in Federal Reserve rates until July the 30th and 31st. The investors are putting a strong possibility of a rate cut in June. I don't think it's going to happen. I think it's a bit too early given our strong inflation numbers. But keep an eye on the balance sheet of the Federal Reserve. The Federal Reserve, in my judgment, is really doing some strange things here. They're slowing down and cutting quantitative tightening, meaning they're going to allow long-term rates to move a bit higher. At the same time, they're going to be cutting short-term rates. Now, that's what Japan engaged in, which we call yield curve manipulation, I'll call it. Yield curve manipulation. That's not a good way to be managing the economy. I think the CPI is going to rise month over month by 0.4%. That'll be for the month of March. That's much too strong. That, of course, multiply that by 4 and you get way above the Federal Reserve's target of 2%. Long-term rates, I think, will move sideways, again, because the Federal Reserve is stopping their quantitative tightening, which would normally push up long-term rates. The prime rate will remain at 8.5% until August the 1st. That's the day after the Fed raises rates on the previous day, July the 31st. The prime rates will go up to 8.5 on the next day. Keep an eye on the bond market. They're very important to keep an eye, and that's the number one factor. Lots of folks are looking at the stock market. No, look at the bond market. The bond market's where the action is. And when the rates on the 10-year Treasury moving between 3.5% and 4.7%, that's in a range we can accept. It gets above 4.7%, real concern. It's not close yet. It would be a real concern that we could see some much higher interest rates from the Federal Reserve. We're not seeing it just yet. Moving below 3.5% would indicate that there's higher probability of a recession. But again, keep an eye on the Federal Reserve's balance sheet. They're saying they're going to allow it to remain where it is, at least don't take any more tightening in terms of long-term interest rates. In other words, leave long-term rates alone. Look at the national ISM reading, which comes out, as I said, later on this morning. If that number is below growth neutral, which I expect, that's another warning signal for the manufacturing sector. Keep an eye on the price of a barrel of oil. It's moving up now to between 80 and 85 instead of 75 to 80. That's going to put upward pressure on inflation. And of course, that again means higher interest rates. Listen carefully to what the Federal Reserve, members of the Federal Reserve Open Market Committee say. What do they say about a rate hike or a rate increase or a rate cut? Right now they're talking rate cuts. That's not to say we don't get a rate increase. There is a potential for a rate increase. I'm not saying that. I'm not expecting that, but it's not off the table. So that was our survey for the month of March. It was not a good survey. Rising inflationary pressures, job losses in manufacturing, an index below growth neutral. But we'll have to wait and see what we get from the month of April. But until we meet again, may your economic cup runneth over. This is Ernie Goss from Creighton University.